President Biden keeps talking about these record 13 million jobs that he, quote, created. Those were just recovered post-COVID.
Yeah, and the labor force from December 2019 is literally only a million. There's only a million more people working than 4 years ago. Right. And so when you think about that you have roughly a million people entering the workforce on an annual basis. What's going on here? This doesn't make any sense. So his record on jobs is a total and complete fabrication. And what's more is you're starting to see credit card debt at an all-time high, and defaults have already surpassed 2008 highs. So we are in a tale of two economies where those in the top, say, 10, 15% are doing spectacularly. The market's up a ton this year. Real estate is recovering. If you're wealthy, you are rocking and rolling. If you are not, this is a devastating economy where everything is ungodly expensive. And all of that has to do with this Biden administration, the amount of money they spent in 2021, in addition to the regulatory policy, and most importantly, the policy on energy. The war on fossil fuels has made every single thing more expensive in our economy for no reason other than so that the green nuts in the White House can pat themselves on the back.
Kelly? Well, what do you think of that?
Yeah, look, I look at the markets and I'm a little bit dumbfounded in that you have tightening liquidity, slowing economy, declining earnings. Normally you get price to earnings multiple contraction, yet somehow they've expanded by over a third since November, and it seems like this is likely to continue.
I think all of that, Mike, is due to the fact that the consumer and the investor is now looking beyond what's happening now. They believe in all likelihood that the Fed's going to start cutting interest rates next year. If, in fact, that's the case, well, then there's better days ahead for both the bond and the stock markets. But that's not necessarily the case for the economy. I do believe if the Fed stays as aggressive and raises 2 more times this year, they're going to push the economy into a deeper recession than would have otherwise occurred on.
Yeah, wait until you see what... And let's keep going here. It is time for the word on Wall Street. It is 7 a.m. Eastern time. Top investors watching your money for us. Joining me now, Cap Wealth Chief Investment Officer Tim Pagliara, and also with me, Michael Lee, here on set. All right, Tim, let's start with Mike Lee. We were talking about Twitter just a couple seconds ago. I want to go back to that company. Elon Musk tweeted over the weekend that the social media giant still has negative cash flow because of its heavy debt and a 50% drop in ad revenue. Now, I realize, Mike, that Twitter is no longer traded publicly, but it is a barometer for social media stocks, if you will.
Yeah, well, Elon overpaid for Twitter, plain and simple. He tried to back out as a form of negotiating a lower price, was unable to, and as a result now is stuck with a huge debt burden for a company. But, this is a guy worth $300 billion. So it's not... I don't know that he wants to sell any more Tesla shares or he wants to give up any SpaceX. Just keep in mind, SpaceX with their satellite internet, Starlink is worth, the latest private valuation was $150 billion. Elon owns, close to 50% of that company, in addition to 20% of Tesla, which is getting back to being close to a trillion-dollar company again. So, look, there are deep pockets there, but the advertising revenue fall off in Twitter, I think, was a little bit more of a coordinated attack because somebody's buying it who was, quote unquote, unapproved. And so when you're not part of the circle that the powers that be want you to own something like that, they're going to make it as difficult as possible. And so I think you'll start to see that returning on any social media platform that has tens of millions of daily active users, can monetize that base, and they deserve higher multiples because it's an interesting business that with really a lot of operating leverage. It'll be interesting to see how that plays out. You've seen Facebook stock on an absolute and total catapult this year, up doing basically a triple from their lows earlier this year, if not more. It doesn't look like that's going to stop. It'll be interesting to see if the ad revenue does come back into Twitter, but I think that is a Twitter-specific problem, not a macroeconomic or something that you can extrapolate to the overall social media space.
Yeah, before I go, I want to go from social media really quick, Tim, and just kind of pivot.
To be financed. Over time, you should see a lot further weakness.
Mike, what do you say?
Yeah, it just seems like we should be in the recession now, given how much the Fed has raised, all this kind of economic carnage that's going on in terms of the economy slowing, earnings declining, yet we're not there. And me and Cho were just discussing the break. The NASDAQ is up over 37% this year.
Yeah.
Is it just because we can't really feel what $8 trillion feels like from the COVID stimulus still in the economy?
I don't think it's the COVID stimulus. That's largely gone. If you look at the 06 to 08 period, a lot of the same indicators, the yield curve, the index leading indicators, told you you're going to have a recession in 07, early 08, and then by the summer of 08, many people thought that the economy was going to improve. The growth actually was positive in the second quarter. Bear Stearns had gotten bought by JP Morgan. And yet by the third quarter, everything rolled over. The lags are such that just because it hasn't happened, it's still within the range of what's likely. And again, I would argue that tightening in monetary policy, as well as the tightening that's coming through the banks, these regional banks, which are massively tightening standards, that lack of credit availability eventually will hit. I don't know when. That's always the tricky part, is what is the exact timing, but it will come.
Let's go. Kelly, I want to bring